And welcome. This is Tchaikovsky, and we're coming to you with some additional questions here for Chapter 20. I guess I should give my usual disclaimer. This is, anything you hear in this video is my opinion. My purpose in doing this particular video is to give those of you who are taking my accounting class additional practice, basically for the upcoming exam. So I've made this question a little bit harder, but hopefully this will kind of make sense. So in this particular question, I'm giving you a cash flow. And what's important to remember is a lot of times on my exams, I'll include questions that can kind of be used to help you with other questions. For example, for this one over here, this is the bankers considering giving a loan. So if I look at this, this is how a traditional cash flow is going to basically be set up. And when we look at a traditional cash flow, and this is not the statement of cash flows, this is really for budgeting purposes, but you have a beginning cash balance plus your cash inflows minus your cash outflows down here. And this gives you your ending cash balance. The important thing to remember, though, is that when we look at things like when we look at a cash outflow, it's not necessarily going to be the same thing as an expense or revenue, depending upon how this is being, basically going through and being used. So I've made this question a little bit more on the challenging side. But again, to give you additional practice, I hope that this will go through and help you out. So we're given these different items over here, beginning cash, and just again, look at the flow of this, no pun intended, plus the cash received from sales. There's a note here, we'll get to that momentarily, gives you your cash available. My total cash outflows are going to be these amounts over here. And of course, I forgot one, which is always why I enjoy doing these questions with you. Hopefully this fixes it. So coming over here, you've got, I'm just going to pause this real quick. So you've got your total cash outflows, which consist of dividends, interest, equipment, insurance, and purchases. So this is our cash outflows. The cash available minus the cash outflows gives you the ending cash balance. The ending cash balance of 1 month becomes the beginning of the following month. And you basically just repeat the same process going forward, right? So this is basically a multi-month cash flow. So what we're being asked to do is to take this information and to create an income statement. Now, notice here, this is not a multi-step income statement. A single-step income statement refers to revenues less expenses, gives me net income. The other thing is that if you're taking my Accounting 1B class, one of the things I had you do at the beginning of the semester was given financial information. I wanted you to go through and prepare financial statements. And this is the reason why. Because when we get to the income statements, right, which are right over here, then we have the statement of retained earnings. The statement of retained earnings is what links the income statement to the balance sheet. So this is why I had you do it. Again, for the balance sheet, I will give you this kind of filter, but again, it's also going to be an unclassified balance sheet. What does that mean? It means we're not going to have to worry about classifying assets as current or non-current as well as liabilities. So let's go ahead and take a look at this particular question. So we need to the first step is always going to be is we need to make income statements, right? So we first need to figure out what is our revenues. So our total revenues less our expenses. I need to go through and figure out what those expenses are. So when we look at this over here, we see cash received from sales. If you see this without any other further notes, you can assume that the cash received from sales is the same thing as sales revenue. However, for this over here, we're given some additional information. And let's go through this. This is very critical. Included in February 2029 cash received from sales was an advance of 50 from a customer. ZI will perform the services at a rate of $10 per month from February 2029 through June of 2029. So what we're tasked with doing is we need to figure out what revenues are. And for us, for the month of January, well, we know over here that our January revenues are simply going to be 500. Well, why is it not different? Well, because this 50 received from a customer basically was an advance in February. So we're going to have to deal with this for the month of February. But let's take a look at February. So basically for the month of February, we received a total of 600 of cash, right? So right over here, we got cash of 600. Normally, when I'm going through and doing these different types of questions, I always like using T accounts. Why do I like using T accounts? Because it can help us go through and get the information that we basically need to solve these types of problems. So I have my assets equals my liabilities, plus my owner's equity, expenses, revenues, debits, and credits. So we got 600 of cash, but when it comes to that cash, it came from two different sources. One is going to be the normal sales, right? The normal sales is going to be how much? Well, included in this 600, right, was an advance of 50. So that means that the normal sales are going to be 550, and the other 50 is going to be basically deferred revenue or an advance from a customer. And this occurred over here on 2/1/29, right? So basically, you can kind of assume it's going to be in basically it was an advance of 50 from a customer, and I'll write this in here on 2/1/29. Let's go ahead and put this in over here on 2/1/29. Sorry, 2/1 there. So we got this advance from a customer. Now, what's important to remember, though, is that what type of account is deferred revenue? Well, deferred revenue is a liability, and this is going to become very important later on down the road. So when I go through and I look at this 50 advance on 2/1/29, the other thing I need to be asking myself is, well, when am I going to go through and recognize basically this 50 as revenue? Well, it tells us that I'm going to be performing the services at a rate of 10 per month from February 29 through June 2029. So let's kind of break this down a little bit further. Let's say this is cash from sales. Basically, we'll call this cash, which is basically sales revenue. So we have here is 500. This is going to be 550 for the month of February. Notice over here, there's no indication about March or April. So the cash from sales is going to be 575 and 700. But for this particular item right here, for this deferred revenue that we got on 2/1/29, I'm going to be recognizing this revenue over a period of 5 months. So when I'm going through and recognizing basically this revenue, I'm going to need to make an adjusting entry, right? So how much revenue do I recognize in the month of February? Well, if I've got February, March, April, May, and June, what I would basically do over here, so I'd say sales February, is I'm going to say, all right, I'm going to credit sales by 10 and I'm going to debit deferred revenue by 10. So I'm going to go deferred revenue 10, and I'm going to credit sales by 10. So remember, I got 600 cash, but not all of that per this note was in fact cash sales, because I included in this amount was an advance from a customer of 50. So what does that mean? It means that I cannot recognize that revenue, that amount as revenue immediately. I have to recognize it over the period of time I go through and do my services. So the way I'm going to go through and do this is for the month of February, I'm going to go ahead and recognize another 10. So we'll call this the revenue from the customer advance. Is I'm going to go ahead and recognize 10 of revenue. So the total amount that I'm going to be recognizing as revenue from this customer is going to be 10 for that month of February. Okay. So this is basically as of 2/28, 29, and this would be the entry that I would do. So my total revenues for February are going to be what? The 550 of cash, right? Because the total amount was 600, but 50 of it was in advance. And then I'm recognizing some of that 50 during the month, because right over here, if I got 50 and then it's 5 months, or February, March, April, May, and June. So the amount I'm going to be recognizing each month is going to be 10 per month. So let's just kind of take this forward, right? So my ending balance of deferred revenue as of 2/28/29 is going to be 40. Well, as we saw over here, what about for March? Well, for March, I got another 575, so we're fine. April, I got another 700. But what about this deferred revenue, or this advance from a customer? Well, what happens? Well, the ending balance as of February 28th is going to become my beginning balance as of March 1st, 2029. And so when I'm looking at this, I then have to say the same thing. Well, how much do I recognize in the month of March? Well, over on 3/31/29, I'm essentially going to be making the same journal entry. I'm going to debit deferred revenue, right? I'm decreasing my liability because I'm going through and earning it. And I'm going to go over here. And if I looked at this, basically sales, and we'll call this sales for the month of March. My cash sales for the month of March were 575. So what I'm going to go ahead and do is recognize the 10 of revenue that was deferred in the month of March. So my ending balance, though, in my deferred revenue is going to be the 40 minus the 10, or 30, and this is going to be on 3/31/29. And if we think about this intuitively, does this sound correct? Well, I got 5 months. I was given an advance for 5 months of revenue. At this point in time, I still have 3 more months to go through and to perform the services. 10 for April, 10 for May, and 10 for June. Remember, the services are being performed for 5 months. So right over here for the month of March, I'm going to have now a total of 585 of revenue. Let's now go to April. I'm going to have to go through and do the same thing. So over here, for the month of April, I'm going to have the same entry, right? But on 4/1/29, my beginning balance is the ending balance of the prior month, right? And so over here on 4/30/29, and if I look at my sales for April, my sales for April were 700. So I've got over here 700. And when I go through to recognize the deferred revenue, or recognize the revenue, I'm going to debit deferred revenue because I've done another month of the service. I decrease my liabilities with a debit. And then I'm going to go over here and I'm basically going to credit sales. So my ending balance in deferred revenue is going to be 20. Now you might be saying, Bennett, why are you going through and doing all this? Because later on, we're going to have to do a balance sheet. When we do a balance sheet, we're going to have to go through and record that deferred revenue. So now my sales for April are not only the cash I received, but also the 10 from the deferred revenue. So let's go ahead now and basically prepare that first part of our income statement, which is basically going to be the revenue. So the revenue right over here, if I take a look at this, this is basically coming from right over here at 500, 560, 585, and 710. So my total revenues are at this part right over here. Now, if I also want to kind of do something to get this out of the way, I can also come down to my balance sheet. And under my balance sheet, I can go to my liabilities and go here and go show deferred revenue or customer advance. Remember, this is going to be 0 for 131.29 because I did not receive that revenue until February 1st. My ending balance of the deferred revenue on February 28th is going to be at 40. My ending balance on March 31st is going to be at 30. And my ending balance on April 30th is going to be at 20. Now, you might also be saying, well, Bennett, why are you going through and doing it like this? I give a lot of partial credit. The deferred revenue, this is worth big points because you have to go through and make special computations. So again, this is something that I would make sure that you're going through and being mindful of. Remember, we are just focusing on our income statement right now, but this is something where you can get big partial credit. So I went ahead and did the other part. So the next one thing over here, it says purchases reflect cost of goods sold. So over here, as we know, cost of goods sold is an expense of selling inventory. So this is going to be cost of goods sold, which is basically the purchases. So my expenses here are going to be 150, 200, 180, and 250. Pretty much that's kind of straightforward. Okay. So the insurance relates to a 2-year policy that will cover us from January 2029 through December 2030. So I paid 48 and it's giving me 2 years of coverage. So when I look at this, I do not want to put insurance expense of 48. That is absolutely incorrect. Why is that incorrect? Because this reflects a benefit of 2 years. I'm doing an income statement for 1 month, so I'm not going to go through and record 48. Rather, what I'm going to do is I'm going to say, okay, I have prepaid insurance, which I basically debited for 48. Okay, so this balance over here, basically, I'm debiting prepaid insurance over here for 48. Now, the key question is the balance of prepaid insurance on 1/31/29 still going to be 48? And the answer is going to be, well, no, because we've used a month of the policy. Remember right over here, it says the insurance relates to a 2-year policy that'll cover us from January, and I'll make this a little bit more clear, from January 1st, 2029 through December 31st, 2030. There we go. And I'm going to go ahead and copy that to this part right over here. Okay. So this is a 2-year policy. This doesn't work because we've actually used up some of this policy. So how much have we used up? Well, the insurance policy was for 48. right? The number of months of coverage, as it says here, it's giving us a 2-year policy. So if it's a 2-year policy, my months of coverage is going to be 24, or 2-year policy, or 12 months times 2, or the monthly amount of my insurance expense is going to be $2,000 per month. So when I'm going over here and I'm basically doing my adjusting entry, right? How do I go through and record expense? I'm going to record an expense, ERDC, with a debit. So I'm going to debit insurance expense for 2. Whenever I have a debit, I need a credit. What do I go through and credit? I'm going to credit prepaid insurance. My ending balance of prepaid insurance is going to be 46. Does this make sense? Well, as of January 31st, I have 23 months of coverage remaining. If the value of that coverage is $2,000 per month, 23 times 2 is 46. So my insurance expense for the month of January is going to be at 2. Okay, so what happens in the next month? Well, let's go through and take a look at that. So over here, my prepaid insurance balance on 2/1/29, it's going to be the beginning balance is the ending balance from the prior month. Coming over here to my insurance expense for February 29, I'm going to record another 2,000 because that's how much I've used. My ending balance on 2/28/29 is now going to be 44,000. I'm going to do the same thing over here for the month of March. My ending balance as of March 31st, 29 is basically going to be over here at 44, or I should say 3/1/29. So my ending balance of 1 month becomes my beginning for the following month. My ending balance for that 1 month is going to be 42 because for March of 29, I'm taking the same amount of the adjustment. Coming down over here to the next month, my ending balance as of March 31st, 2029 becomes my beginning for the following month. So my balance is now down to 40, and this is going to be for the month of April of 2029. So as you can see, this is what we have to go through and do. Now, do you need to show all of this work? The answer is no. Why am I showing you this? Because I know for a lot of you, counting 1A was a long time ago in a galaxy far, far away. So hence my reason for over-explaining, which I tend to do all the time. So the amount of my insurance expense was not going to be 48. It's not the cash being paid. Rather, it's going to be over here at 2,000 per month over each of those different months. Now, another thing I'm going to do over here is I'm also going to go to my balance sheet. And I'm on my balance sheet, I'm going to record prepaid insurance. Again, this is going to give me big points. My prepaid insurance as of January 31st, 2029 is at 46. Right, so right over here, my prepaid insurance is at 46. My prepaid insurance as of February 28th is going to be at 44. My prepaid insurance as of March 31st, 2029, and my prepaid insurance as of April 30th is going to be at 40. Why does that 40 make sense? It's a 24-month policy. I've used 4 of the months as of April 30th, 2029. I have 20 months remaining at 2 per month. The value of this is going to be 40. Remember, whenever you do an adjusting entry, the expense needs to reflect what was used in the period, and then my asset or liability needs to reflect my future obligation or my future economic benefit. Okay, so we've dealt now with notes 1, 2, and 3. The next one we need to go through and look at is we had a $300 equipment purchase that was made on January 1st. The equipment will have a useful life of 4 years and has a salvage value of 60. We use straight line depreciation to depreciate our equipment. Love the English. It's all that's 3.5 years of law school for you. Okay. So coming right over here, let's go ahead and do note 4. When I go through and look at when I purchase equipment, the thing you do not want to do is say equipment expense for 300. That's not how we go through and do it. When we purchase an asset, and this again goes back to financial accounting, the way we show the use of that asset. So we're going over here, we are recording equipment, and we credited cash for 300 and 300. But when we use that equipment, what we're going to need to go through and do is to record the expense of the use, which is what we call depreciation expense. And the corresponding account that goes with depreciation expense is accumulated depreciation on equipment. This is a non-cash expense. Don't fall into the trap when I put over here where I'll say like, oh, I'll sometimes put on exams where I'll basically go through and I'll say, yeah, depreciation expense was 10,000 per month. I will get a student that will put in depreciation expense into the cash flow. You don't do that. And the reason why is because when we show the purchase of the equipment, that's really when the cash is going out. When we're recording depreciation, it's just showing the use. It is a non-cash item. If we go over here and we're going to look at an SEC filing, when we look at the statement of cash flows, which is not exactly what we're doing over here, but when we go through and look at the statement of cash flows, the first thing you're going to see being added back to adjust net income is right over here at depreciation and amortization. It's an add back to net income because it is a non-cash item. So when we go through and record depreciation expense, how do we do it? We're going to take the acquisition cost minus our salvage value, and we're going to divide that by our estimated useful life. Over here, our acquisition cost was 300. It had a salvage value of 60. The estimated useful life was 4. So right over here, this is going to be 240 divided by 4, or 60, which is going to be my annual depreciation expense. Okay, so this is an annual amount, meaning for 12 months. Do I want to write 60 here for depreciation expense? No, I do not, because this is a monthly amount. So what I need to go through and do is take the 60 of annual depreciation expense, and I need to divide this by 12. When I divide this by 12, I get monthly depreciation expense of 5. And so that's something we want to kind of go through and consider as we're doing this type of problem. So for the month of January 2029, I'm going to debit depreciation expense for 5, and I'm going to go through and credit the accumulated depreciation on the equipment. Now, sometimes I will give you a balance sheet where they've already started depreciating the equipment. Just have to note there that you're just going to keep on continue to depreciate it. So over here, as I purchase this on 1/1/29, my opening balance is going to be 0, right? I depreciate this over here. My ending balance as of 1/31/29 is going to be 5. When I come over here to do this for the following month of February, remember, we're doing straight line depreciation. So I'm going to take the same amount each month. My ending balance on over here on January 31st becomes my beginning on February 1st. So my basically over here, I'm taking 5 of depreciation expense, crediting accumulated depreciation on equipment. My ending balance over here is going to be at 10. Remember, this is a contra asset account, meaning it has a credit balance. So when I'm showing this on my balance sheet, I'm going to show equipment at 300 less my accumulated depreciation in the equipment. This is going to give me equipment net of 295. So this is what I'm going to be going through and doing every single month. So coming over here, do you need to do this on your exam? Absolutely not. But I want you to understand where the numbers are coming from. So over here, my ending balance becomes my beginning for the following month. So over here, with the ending balance as of, because I've taken 2 months of depreciation, the accumulated depreciation is now at 10. The ending balance of that becomes the beginning balance of the following month. So over here, I'm now going to go ahead and do this again. For April 2029, I've got over here, so my 4/1/29, and then this is going to be my ending balance as of April 30th is going to be at 20. Okay, so what I'm going to do now is something similar to what I've been doing so far. The depreciation expense is going to go on to my income statement. My depreciation expense is going to be 5,000 every month. Now, at the same time, what I also want to do is I want to come over here to my balance sheet. And the one thing I'm going to do a little bit differently is I'm going to kind of make this, because of the format I usually like to do with this, is let me go ahead and do this. So what I like to do when I'm showing equipment, okay, is what I like to go through and do is say, okay, I've got, and by the way, you don't have to worry about this in terms of being a classified or unclassified balance sheet. You're gonna have equipment less accumulated depreciation on the equipment is going to give you equipment net of the accumulated depreciation. So over here, my equipment balance is always going to be at 300. However, my accumulated depreciation, it's going to start over here. For the first month, it was at 5. I'm adding on another 5 every month. Remember, again, this is straight line. Okay, so my equipment net is going to be right over here, 295, 290, 285, and 280. Okay, so again, I'm going through and doing this problem a little bit differently, but I'm going to try to capture as much partial credit as I possibly can. Okay, so the interest payment relates to a monthly interest on a loan payable of 400. The annual interest rate is 12%. If I took 400 times 12%, I would get 48. If I divide 48 by 12, I'm going to get 4 per month. So this loan payable, this interest means that I'm basically paying, the cash is being paid for interest. So over here, I'm just going to go ahead and record interest expense. And this over here is going to essentially be, it's going to be the same thing it is on the cash flow of 4,000 per month. Okay. Now, with the dividends, does this go on to the income statement? The answer is no. This is what we give back to our owners. So this is going to go on our statement of retained earnings. The format of the statement of retained earnings is our beginning retained earnings plus our net income less our dividends. And this is going to give us our ending retained earnings. So when we have dividends, right? So my dividends right up here are going to be at 8, 10, 15, and 22. Just pulling these off of the cash flow. So let's go through this again. I went through and I dealt with the cash received from sales. I had that tricky thing with the revenue, dealt with that. Next thing, purchases, same thing as cost of goods sold. Insurance expense, this is for a 2-year benefit. Have to record the expense over a 2-year period. The equipment, right? I'm going to depreciate this over the estimated useful life of the equipment, which is 4 years. The interest represents the monthly interest on a loan, and the dividends do not go on the income statement. Right. I also wanted to take a look really quickly. Is there anything else on the balance sheet that might be of relevance? Really, no. So now I'm ready to complete the rest of my income statement. So my total expenses are going to be the interest plus the depreciation plus the insurance plus the cost of goods sold. Over here, it's going to be 211 or 200 plus 2 plus 5 plus 4, 191, 180 plus 2 plus 5 plus 4, 261, 250, 2, 5, and 4 is 261. So my net income is going to be 500, which were my revenues, minus my expenses, or here it's going to be 339, 349, 394, and 449. So this over here is going to be my income statement solution for this particular question. Okay, so done the income statement. Now, when it comes to the statement of retained earnings, I start with my beginning retained earnings. Well, what were the beginning retained earnings? It's going to be whatever the ending was for the prior period. So the ending balance on 12/31/28 becomes my beginning balance on 1/1/29. So over here, my beginning retained earnings are going to be 170. I'm then going to go over here and then add in the net income. The net income was 339. My ending retained earnings are going to be my beginning plus my net income minus my dividends, or I'm going to get a total here of 501. My ending retained earnings becomes my beginning for the following month. My net income was 349. So my ending retained earnings are going to be my beginning plus my net income less my dividends, or what I gave back to my shareholders, or 840. This ending balance here becomes my beginning for the following month. My net income was 394. So my ending retained earnings is my beginning plus my net income minus my dividends. This now becomes my beginning retained earnings for the following month. I add in my net income for the month of April, less my dividends, and this is going to be my ending retained earnings. Remember, retained earnings is a component of owner's equity. So let's just go through and put in some more information that we know now. My retained earnings right over here was 501. Over here was 840. Over here was 1219, and over here was 1646. Now, the other thing I also want to go through and do as well is to start kind of filling out my balance sheet. My cash balance is what my ending balance is on my cash flow. So right over here, my ending cash balance as of 1/31/29 is going to be 990. Over here as of 2/28/29, it is going to be 1376. Over here as of 3/31/29 is going to be 1752. And then as of April 30th, 2029 is going to be 2176. Let's see what other assets we have. Well, we've dealt with the cash. Oh, we have something called other assets. Let's go ahead and put that in here. Remember, it's not a big deal. I don't care about the order. So the other assets, just assume that this balance is just going through and carrying over from the prior balance sheet. But note what we've done here by dealing with the prepaid insurance as well as with the equipment, we're making our lives a little bit easier. So our total assets are going to be the cash plus the prepaid insurance plus the equipment net plus the other assets are a total of 1401. For February, it's going to be 1780. For March, it's going to be 2149. And then for April, it's going to be 2566. Now, in terms of my liabilities, right, what do I have here? Well, the only liability I had as of December 31st, 2028 was a loan payable. Again, I'm not concerned about the, about any other like current versus non-current. So I'm going to go ahead and record this loan. Remember, I'm going through and making interest only payments. I would not do something where it would be like, oh, interest plus principal. Remember over here, because I had that deferred revenue. By me now going here and addressing this, this is starting to make a lot more sense. So over here, I've got my total liabilities for each month, basically a 400, which was just the loan. The deferred revenue did not kick in until the month of February. Then I've got March, and then I've got over here, I've got April. So in terms of my other component of owner's equity, I'm going to have common stock. My common stock was right over here at 500. So over here, I've got common stock for every single month, hasn't changed, right? The balance is just going through and carrying over. My total owner's equity is going to be 1,001. This is going to be 1,340. This is going to be 1,719. And this is going to be 2,146. My total liabilities and owner's equity, it's going to be my liabilities here plus my owner's equity, or 1,401, 1,340 plus 440, 1,719 plus 430, 2,146 plus 420, or 2,566. If you notice, my total assets over here equal my total liabilities and owner's equity. So I'm essentially good to go, and I have completed this problem. I can tell you right now, if you do not remember a lot of stuff from Accounting 1A, you're going to need to be able to go through and figure it out. I think with this particular question, as I'm going through and looking at it, this is about as kind of as challenging as I can kind of go through and make it. Again, this is just something you absolutely have to know how to do in terms of going through and getting prepared for this exam. Hopefully, though, this was helpful. If you'd like to see more videos or other things for these additional problems, please feel free to message me. Look forward to seeing you soon, and have a great rest of your day.